Hi, welcome to the Society of Actuaries webinar. We're just going to start in a few minutes. You're very welcome. Hi, welcome to the Society of Actuaries webinar. You're all very welcome. We're just hitting 50 participants now in the door. We're just going to start in a few minutes. Okay, we're just coming up to 70 participants. We're just going to give it another few seconds. You're all very welcome to the Society of Actuaries webinar. Okay, I'm going to start. You're all very welcome. My name is Mike Laffey. I'll be host today. I'm chair of the Life Committee in the Society, and welcome to a Life Committee found, but open to everybody, a talk on putting the life company balance sheet under the ESG microscope. Just one or two housekeeping points before we kick off. Thank you for joining. We're recording this webinar and it will be available to others afterwards on the ActiveView platform. Just to warn you or to let you know, we're recording this full webinar, including the Q&A at the end, and this is scheduled to be a 60-minute CPD session. As you go through the listening and watching the presentation, you can raise a question by typing on the Q&A portal on the platform. You'll see that at the bottom of your screen. If you have your mouse down low, there's a Q&A. So please, if questions hit you as you go through, please ask them, type them in there. But we will be letting our three speakers go through the presentation and taking the Q&A at the end. I'll explain it to you later, but you can also raise your hand in the Q&A session at the end, and you can ask a question live if you don't want to type it in. You have registered, so again, this is a CPD event. It is verifiable for a Society of Actuaries CPD, and by attending, we have the fact that you joined it and what time you leave, and then the Society will maintain that record for your CPD purposes. Okay. So we have three speakers today, and thank you to the three of them. We have Ross Evans. Ross leads up the insurance, investment and asset liability management team, the ALM team in Hymans Robertson Life and Financial Services practice. He's an actuary, a life actuary with over 17 years experience with a wide range of consulting experience. He'll be joined by two of his colleagues from his team in Hymans Robertson's, Mohan. Liam is an actuary and a consultant in the life team as well, but a particular focus on investments and asset liability modeling ALM, and a broad range of experience to a variety of different client engagements. And Clarence is a senior consultant on the life team in Hymans Robertson as well, with, again, specializing in fields of insurance, investment and risk and capital management. Life actuary has worked on projects including IFRS 17, retirement products and climate change. So the running order is, and let me just, apologies. The running order is I'm going to hand over to Ross now, and then Ross is going to bring us through the session, followed by Liam, followed by Clarence, and then we'll know we're nearly at the end because Ross will come back and summarize for us all, and we'll open the Q&A. So over to you, Ross.
Great. Thank you very much, Mike, and good morning, everyone. So here we have on the slide then what we're going to cover. So we'll probably, between the three of us, talk for about 40 minutes. So I'll start with a bit of a refresher on what ESG means and why we should all care about it. And then I'll hand over to Clarence and Liam, who are going to look at how we can map the various ESG risks to the life company balance sheet. And for those ESG risks that, as we'll talk through, have a very uncertain future outcome, so things like climate change, we'll look at how firms can construct scenarios for stress testing purposes. And then towards the end, we'll look at how we can put all of this into practice with some real world examples. And I'll finish up by looking at some practical hints and tips for things that firms can be doing by way of next steps. So that's the agenda. So if we can click to the next page, please. All right, so we'll start with what do we mean by ESG and why should we care about it? Okay, so we can click again. So ESG, as I'm sure many of you will be aware, stands for environmental, social, and governance factors. So these are the three sets of factors that ultimately determine the long-term sustainability and the societal impact of an investment in a particular company or business. So what you can really think of these as a set of non-financial performance indicators for a company. So if we can click again. So what we've put here on the slide is an example taxonomy of the sorts of things that fall under the three E, S, and G headings. And some of these will be very recognizable to many of you. So for example, under the environmental heading, we have climate change, which is clearly a very topical one. And under the social heading, we have things like ethical labor practices and technological change. Now, traditionally, investors have really focused on financial metrics, financial performance indicators when analyzing an investment. So you trawl through reports and accounts, financial presentations, and look at things like return on equity, working capital, things like that. But now with ESG or sustainable investing, what we're trying to do is take into account all of these non-financial factors that you can see here on the slide, and we add those together with all of the usual financial metrics that we would look at. And it's the collection of all of that information that we now use to make our investment decision. And with that much bigger wealth of information, that should make a much more informed decision and ultimately lead to better outcomes. A couple of things I think is worth highlighting on this slide. The first one is that clearly not all of these ESG risk factors will impact all companies in the same ways and to the same extent. Good example of that would be an oil and gas company. Now, clearly, the long-term sustainability of a business like that will be very heavily influenced by these environmental factors. So, the depletion of raw materials, the pace at which we transition to a low-carbon economy. But contrast that to, say, a high street retailer, very different business, and it's going to be much less affected by those sorts of things. However, it's probably going to be much more affected by some of these social factors. So, for example, technological change, the extent to which that business can remain relevant in an increasingly digital age. So that's the first point. And then the second one, as you might imagine, is that these factors don't act in isolation, and we do often find there are strong interdependencies between many of them. So again, climate change and technological change, good examples of that, one driving the other. You think about the big push that we're seeing into electric vehicles. Well, that's all as a result of climate change. We're trying to get carbon emissions down, so we're looking to drive a move away from the combustion engine into electric vehicles. Okay, so what we'll do now is look at a few real-life case studies of these ESG factors impacting companies in the real world to bring this to life. And we'll look at one example for each of the environmental, social, and governance headings. Okay, so if we can click. Thank you. So we'll start by looking at environmental factors. And the company that we've shown here, the example we picked out, is Coca-Cola. And the environmental factor in question is water usage. Now, when we were pulling together our examples, it wasn't immediately obvious to me why you'd link a company like Coca-Cola with water usage. But what we found and what you can see from these press clippings is that Coca-Cola has been repeatedly running into conflicts in India specifically because of their water usage practices. So they require a lot of water for their operations. But those water usage practices were having quite a significant and detrimental impact on the local communities. So what that resulted in was Coca-Cola having to, in fact, shut down some of its factories and even had its products boycotted for a period of time. So again, you can see that a risk factor there that you might not immediately link to a company like Coca-Cola actually had sort of quite a sort of significant impact on that business. So again, as an investor, it would have been important to consider that kind of environmental factor and the impact it may have had on your investment. Okay, so if we can click, we'll now take a look at an example of the social factors. So the companies we've shown here are H&M and Sports Direct, a couple of household names, and the social factor here is ethical labor practices. Now, these headlines, again, may be familiar to many of you. You can see, sort of statements around poor working conditions, unpaid staff, and tragically on the right-hand side there, we saw the collapse of a building which killed over 1,000 workers. And so here, really, these sorts of practices really sort of call into question the long-term sustainability of these organizations. If these practices continue, you could see a situation where their products are boycotted. So if you've invested in that company and they don't change their ways, then the financial value of investment is probably going to be impaired over the long term. And then our final example, if we click down, so this is now looking at governance factors. This is a very topical example as well. So the company we've picked out here is PG&E, which stands for Pacific Gas and Electric, which is a utilities provider in California. And as you can see here, it's been making headlines for all of the wrong reasons. So their equipment and their approach to environmental management is thought to have led to 12 wildfires during 2017, and also the record-breaking Camp wildfire that we saw in 2018. And following the 2018 fire, PG&E were facing $30 billion worth of fines and reparation costs. And ultimately, this led to them becoming the first investment-grade bond issuer to default in over 5 years. So very much an accolade that nobody would want. But at the heart of all of this was inadequate governance and a failure of management to have a clear vision for safety. So again, imagine as an investor in one of those bonds, that poor governance, has led to ultimately a default, and so there would be a significant impairment to the value in your investment. So that's all I was going to say by way of introduction on this. So that's my refresher on what ESG means. Hopefully, those examples really bring to life why it's so important to consider some of these factors in the investment decision-making process, and the material impacts that they can have over the long term. So what I'll do now is I'll hand over to Liam, and we'll take a look at how we can link some of these ESG risk factors across to the life company balance sheet. Liam.
Yeah, thank you, Ross. So in this section, as Ross noted there, we're going to talk through a framework for thinking about these risks and then ultimately leading them or linking them to the life insurance company balance sheet. And we're going to do this in the context of climate risk, as really this is the big systemic risk that we're all exposed to, and naturally, therefore, it's the one risk factor getting a lot of attention from governments, from regulators, and from other industry bodies as well. But before we get into that, we can't have a presentation in May of 2020 in the middle of a global lockdown and not mention everyone's favorite subject of coronavirus. And personally, I think climate change is quite an interesting, climate change and also our prospects for tackling climate change. It's quite an interesting subject to think about in the context of today's COVID-affected world. Now, I'm sure you've all seen a chart like this one here, which shows the fairly dramatic reduction in greenhouse gas emissions that we've seen right across the world since we went into lockdown. And whilst charts like this do show a positive short-term improvement, it also gives us the sense of the scale of the long-term adjustments we may need to make to really effectively tackle climate change. Now, there was analysis done in certain areas of the world from early March or from early in our lockdown around March time. And it suggested that emissions had reduced by about 25% due to the lockdown, due to a reduction in air traffic, manufacturing, and so on. Recent scientific estimates, however, suggest that we might need to reduce emissions by about 50% over the next decade if we're really going to hit our more optimistic warming target, something in the region of about 1.5 degrees of warming in total. So what this tells us is that we may need to make adjustments to our lives, which are on the scale that we're currently seeing, and then some on top of that, if we're actually going to tackle this problem effectively. And then I guess a bit closer to home for us here today, it's also interesting, I think, to think about this in the context or from the perspective of investors. Now, obviously the lockdown, we've all seen that the lockdown has hit certain industries, certain companies particularly hard. And there's no doubt that many of them will be looking for government support over the kind of months and even over the years ahead. But we're now hearing calls in the press from different industry bodies for government support only to be provided to those companies and to those industries that will actually commit to taking lasting action on climate change. Now, whether or not the government actually takes this kind of information or these views into consideration when making their decisions, that's another matter. But it will perhaps highlight for us as investors that there are genuine financial risks here that are associated with certain investments, maybe driven by changing public sentiment, by an ever-changing kind of government policy, which aren't fully captured by credit ratings or other more traditional financial metrics. And just as Ross said, it kind of highlights the importance for us of factoring in this broader set of information, this ESG information as well, into the decision-making process. Today, however, we're going to focus more specifically on the link between climate change and the life insurance company balance sheet. And ask the question, well, how can this really materialize for life insurers? So that's where we'll begin with climate change. And where are we trying to get to? Well, here's a list of things that we can come up with and say, well, look, this is what insurers care about. These are the things that affect the financial health of an insurance company, and they might all be affected by climate change. So we could see a rising cost of borrowing, depending on how economic growth changes. We might see volatility of asset prices, and there may be a change in mortality rates. And if you're an annuity writer, maybe that's a good thing, but certainly there's going to be some uncertainty over future mortality rates. You may have to hold extra capital. We hear talk of that maybe coming in the pipeline, that insurers will have to actually start increasing their reserves to protect against climate risk. And we may even see issues with capacity in the reinsurance market if reinsurers are continuously hit with the kinds of record-breaking losses that we're seeing at the moment, kind of year on year. And these are all potentially driven by climate change. But the key question is, how do we introduce some rigor into the process of estimating this impact, rather than just sticking our finger in the air? Well, we take a step back and just ask, what are the sequence of events that will ultimately lead to these impacts? And what you find is that many of the steps in this chain can be backed by some sort of data or some sort of academic research. And we can use that to make small incremental steps rather than making one big leap. So the first step in the journey is to think, well, what are the direct impacts of climate change? And we can begin to list them out. Now, I should say, as we go through this framework, that the lists we include here are not intended to be exhaustive by any means, but really this should just give you a flavor of the kind of key impacts at each step in the journey. And then just picking a few of the examples I've got here, picking a few of those out. Firstly, we'll experience warmer average temperatures on the whole. There's a 2014 report from the IPCC, and they're suggesting that average temperatures in Europe are already over 1 degree warmer than they were in pre-industrial times. So, often the problem of climate change is framed as a future problem, that, by 2050, this will happen, by 2100, this will happen. We're already seeing effects from climate change come through right here on our doorstep. As well as warmer average temperatures, we're likely to see less extreme cold in the winter as well. Now, this beautiful image we've included here of people picnicking in the park was not taken on a lovely summer's day, but was instead from February of last year. And this was during a kind of a week-long period during which the UK recorded its own warmest ever winter day, with temperatures topping out at just over 21 degrees in the middle of winter. It is worth noting, though, at this point that this did come just about 11 months after the beast from the east swept across the UK and caused chaos for transport systems and so on. And temperatures dropped to about -5 degrees at that point. So whilst the frequency of extreme cold is expected to drop in future, we may actually see an increase in the daily volatility of temperatures. And that's what can be really disruptive, for transport systems, for healthcare systems to deal with and manage effectively. And finally, on this screen, things are going to get a lot wetter from increased rainfall and also from rising tides. And since this presentation was originally intended to be in Dublin, we thought we'd pick out an example for Dublin here. And we're showing a projection, under fairly central assumptions here, by no means an extreme projection, but looking at the areas which are expected to be flooded once a year on average by 2050. So again, real tangible effects coming through from 4 towns and 2 towns and cities right close to home. Like, this is not a problem that's just going to be felt on the other side of the world. Now, our initial plan was to take each one of these impacts and get into the downstream impacts of each of those, but sadly our request for a 3-hour speaking slot was declined today. I don't know why, but we didn't get it. So we're just going to pick one of these and focus on that for now. And that is extreme heat in the summer. But similar pictures like what we're going to draw here could be drawn really for each of these effects. Now, so as I mentioned, we'll have higher average temperatures on average, but we are also likely to see more extremes of high temperatures in the summer. So the question then becomes really, what are the possible effects of extreme summer temperatures? And again, we can start to list some of these out. I'm picking out a few of these. Again, Europe as a whole is expected to see more frequent and lengthier heat waves. In 2019 alone, we had 2 record-breaking heat waves last summer. First one came in June, and then our second one came just a month later in July and broke the records that were set 1 month prior. And it was during that second one, actually, that the UK's all-time temperature record was broken. So more frequent heat waves. We may also see a shift in migratory patterns. So there's a scientific publication, medical publication, the New England Journal of Medicine. And they projected that we're likely to see, that we may see, a 175% increase in climate asylum seekers to the EU each year by the end of the century. Now, to put that into kind of real figures, that's an equivalent of an additional 660,000 people every year coming to the EU because the places where they're coming from are no longer habitable due to climate change. And recent evidence would suggest over the last few years, what we've seen right across Europe, is that a shift like this is likely to cause significant social and political implications right across the continent. And the final one I'll pick out on this screen is the impact on global crop yields, which may not surprise you, but these are likely to be adversely affected as certain crop growing regions simply just become unsuitable for agriculture due to extreme temperatures, as we're focusing on here, but also due to drought as well. Whilst this may not be such a direct issue, in our more temperate climates here in Ireland and in the UK, it's important to note that we do rely on the import of many of the crops, to feed our countries every year. So whilst this may not be a direct impact that we feel, we are likely to be indirectly impacted down the line. Okay, so those are some of the direct impacts from extreme heat in the summer. And at this stage, we can ask the question, well, are these things that insurance companies are directly affected by? And, looking at this, it's not clear that they are. Workforce productivity, maybe, but, in the UK, perhaps not such an issue. And many of the others, it's not quite clear how they directly affect insurance companies. So what we do is just repeat this process and think, well, what are the potential knock-on effects from each of these impacts that can arise from extreme heat in the summer? And so we can do some research and start kind of listing some of these out. And what you find is, as you go further and further down this chain, we see that the network of effects here and how they all relate to each other does become increasingly complex as we go down through the steps here. But these are still impacts that we can logically hypothesize about. So, for example, we know that demand on public health services increases during heat waves. So the UK had a record-breaking, or then record-breaking heat wave in 2003, and that lasted for 10 days, and it resulted in an excess 2,000 deaths in the country during that period. So, on average, 200 extra people dying every day. So, there is an impact here on healthcare services. We may see an increase in the so-called urban heat island effect. So this is an effect where cities and built-up urban areas store, trap heat more so than the rural areas surrounding them. There's one study carried out in the middle of, focused on the centre of England, West Midlands, during that same 2003 heat wave. And what they found was that actually 50% of all the excess deaths caused during that heat wave were driven by this urban heat island effect. So, people in cities can be much more affected by these rising temperatures than people in rural areas. And then just picking up on the crop yields point again, really one of the key issues with this is that it's likely to lead to a less diverse diet for us right around the world. The story with crops isn't necessarily the most simple one. Certain staple crops are actually projected to do fairly okay. They're fairly robust to changes in the climate, but what is projected is that we're likely to see a convergence in dietary habits, and the kind of variety that we've become so used to over the last kind of 50 years anyway, that's going to start to taper away, and actually as many of the non-staple vegetables in particular start to suffer due to climate change, and obviously some nutritional knock-on effects for our bodies from that. And when we get to this stage, we're starting to arrive at terms that look a bit more familiar to actuaries: property damage, mortality rates, economic output, the kinds of things that we're a bit more comfortable talking about. But we're probably still probably not quite there in terms of things that are directly hitting our balance sheets. So we carry this process on for one more step, further building out the complexity, and further considering downstream impacts of each of those initial impacts. So, for example, here we may see a strain on government budgets coming from multiple different sources, healthcare systems, social care systems, public infrastructure damage, all putting additional strain on the government. We may also see an increase in insured losses, mainly affecting the GI side here, but also, as I kind of mentioned before, capacity, affecting some of the key reinsurers that also operate on the life side. So, we can't think of GI and life in kind of siloed operations. There's going to be some interdependency between the two there. And then really, in case this wasn't getting complicated enough, to further complicate this story a bit more, we can think about compounding effects and the possibility of feedback loops being introduced into this system. So, for example, the increase in preventable diseases we have here, this may further exacerbate stresses on the healthcare system, whilst CO2 emissions from wildfires takes us right back to the beginning and kicks the whole process off again. But finally, we are starting to bridge the gap and arrive at factors that insurance companies will be directly impacted by, things that are most relevant for their customers, for their operations, and ultimately for their balance sheet. And so at this stage, we can think back to our original list and finally think, well, where do each of these fit in? Now, as you'll see, as I've kind of alluded to here, this has become a bit of a complicated story. There are definitely missing links here as well. And remember, this is just going down the stream from extreme summer temperatures. But already this is becoming fairly complex and probably not something that you could model effectively or get meaningful results from, particularly from the outset, if you're just starting to engage with this subject and kind of go through this journey of thinking through the impacts of climate change. So, a natural first step at this stage is to say, well, what is the key variable or the key assumption that I'm concerned with here? And you might decide that that is the impact on mortality rates. Well, at that stage, you can just say, well, let's forget about the rest of this web for the moment. And let's just focus in on the factors that lead to future uncertainty over mortality rates. And let's dedicate our time and our attention to thinking through and to quantifying the impact at each stage in this journey. Now, what this network that we've discussed here doesn't capture is the level of uncertainty associated with each of these outcomes. And even climate change itself, the catalyst for this entire network, the thing right at the beginning, kicking this all off, is uncertain. We don't know how effective we'll be at tackling greenhouse gas emissions. We don't know the motivation we'll see from governments around the world. And therefore, we don't know really what level of warming we will experience. And as I kind of alluded to at the beginning of this section, we might know what path we're on or think we know what path we're on. And then suddenly something can come and completely blindside us, like the coronavirus, and completely change the outlook for the next 5-10 years. But so the typical way to address this uncertainty, and the way we've done it, is through the use of scenarios to capture, I guess, different possible versions of a future world in which we can apply this kind of framework and this kind of logical thinking. So on that, I'll now pass you over to Clarence. He'll talk through that process of developing scenarios and then putting them into practice in a bit more detail. Clarence, over to you.
Great, thanks, Liam. So for this part of the presentation, we'll keep with the theme of climate change and focus on how we could use scenario analysis to assess the potential impact climate change could have on an insurer's balance sheet. I'll take you through the approach that we've taken on this, which we could think of as a two-stage process. First, we've developed an approach to determine how our climate, so the very starting point in Liam's network we've seen early on, may look like in the future. So once we've done this, we are then able to step through the various stages in that network to start performing some quantitative assessments of the impact of climate change on an insurer's balance sheet. So we move on to the next slide. So where do we start in terms of constructing scenarios to assess how our climate could look like in the future? So the main objective in this part of the process is to try and determine the ultimate temperature we could experience in the long term and how we get there. This would then dictate, the level of disruptions firms would experience through one of the following sources. So firstly, through physical risk, which results in financial losses incurred by physical damage to property or other financial assets. Or secondly, through transition risk, which results in financial losses incurred in the transition towards a low carbon economy. Now, a key driver affecting how our temperature changes over time is the nature of policy response that we experience. And this is how we've approached scenario analysis. We've shown on this slide a chart from Climate Action Tracker, which sets out the level of carbon emissions and projected warming based on the different levels of policies implemented by governments. So this helps put into context that, it's policies and responses from the different parties that will be the key driver on how our climate will look like in the future. So if we click onto the next slide, the next step would then be to think about the different parties or factors that could influence how our world looks like. And we have identified four main ones on this slide. So starting from the bottom, we have the environment. The environment itself will provide a signal which may cause firms or companies to react in a certain way. But the environment is usually a result from the different actions that have been taken rather than being a driver. Then we have the general public, and we know who could press for change, as we have seen with the protest by the Extinction Rebellion. But the changes will ultimately manifest through other parties. So moving on then to the next party, which are corporates, the level of engagement and speed of response from corporates will be an important factor, as they are one of the main contributors of carbon emission, and therefore have the ability to really make an impact. Finally, we have governments who have the ability to implement policies to drive corporates to take actions, for example, through imposing higher carbon taxes. And this will have a direct impact on the level of carbon emissions. Governments also have the ability to encourage investments in infrastructures which will help the transition into a green economy. So from this, we are able to see that it is the actions from corporates and governments that will have the greatest impact on how the climate changes. So clicking on the next slide, based on the conclusions from that we've gathered, we've came up with three scenarios representing the different level of responses. So on one end, we have the head in the sand scenario, shown in the bottom left of the slide, where there's lack of responses from governments and corporates. We then have green revolution scenario on the other end, which represents a scenario where there's quick response from governments and corporates. Finally, we have a third scenario that lies somewhere in the middle, which we've called challenging times. So this was something that we've thought about a couple of years ago, and it's good to see that the Bank of England has adopted a similar approach in terms of using the pace of response to determine the scenarios in their 2021 biannual scenarios that it has recently consulted on. So moving on to the next slide, once we've determined these scenarios, we are then able to use the network that we've seen earlier to come up with the associated narratives for each of them. So this is done by thinking through the implications of the temperature that could be achieved under each of the scenarios on each step of the network. So we've provided a description for each of the scenarios on this slide, but I'm not going to go through all of them in detail. Instead, if we use the head in the sand scenario as an example, so this scenario represents a lack of response from governments and corporates, which means that carbon emissions are not controlled. This in turn will lead to global temperatures rising significantly above the 2-degree target, which eventually leads to a range of disastrous outcomes. So these outcomes could be things such as, global crop failures, influx of new diseases, or increase in preventable diseases, or even severe temperature fluctuations resulting in harsh flu epidemics, all of which will result in an increased demand on the healthcare system. So these are the things that we've seen in the different stages of the Hymans network earlier. So moving on, once we've constructed some narratives, we can then start to translate some of these into impacts. In the next section, we'll first take a look at the impact on the liability side of an insurer's balance sheet, before expanding this to also consider what could happen on the asset side. So in terms of the liability side of the balance sheet, we start by looking at mortality rates and how they could be affected under each of these scenarios. The approach we've taken here is to consider how the parameters we've used for projecting future mortality could be affected under each of the scenarios. This allows us to then obtain revised projected life expectancies for different age groups and gender under the different scenarios. So we've taken this from a paper that our sister company, Club Vita, published a couple of years ago, titled Hot and Bothered. Using the comprehensive longevity data that we are able to assess, this allowed us to assess the implications of the scenarios on longevity rates for different groups. And this in turn allowed us to then quantify the impact on the typical annuity portfolio. So on the left-hand side of this slide, we've shown the base life expectancies for a 65-year-old male and female, which are represented by the dotted black lines. Now we can see that under the head in the sand and challenging times scenario, which we've shown as the blue and purple lines respectively, the life expectancy reduces relative to the base position. Whilst the opposite is observed on the green revolution scenario, which we've shown as the green line. From this, we are then able to assess the implications in terms of liability values for a portfolio of annuity, and this is what we've shown on the right-hand side of this slide. So I'll pick out a couple of interesting things to note from this analysis. Firstly, we may naturally be more inclined to focus on climate change outcomes, which would be bad for mortality, and we would therefore expect mortality to increase. But as we can see, in the green revolution scenario, mortality actually reduces relative to the base position. Secondly, for firms providing annuities, one could argue that purely looking from a liability side of the balance sheet, poor response to climate change could actually be beneficial as liability values fall. But we should not forget that climate change also affects other parts of the balance sheet, and quite significantly on the asset side. So that's what we've tried to assess next. So using the same scenarios, we are able to again use the narratives to consider what might happen to the economy. As before, we've picked out the challenging times scenario to consider in greater detail. We start the process by thinking about the implications of the scenario for the various market drivers, both in the short term and also over the longer term. In the short term, nothing changes as governments and corporates are not doing anything to tackle climate change. Therefore, we actually observe that things such as GDP and inflation are relatively unchanged, and equity returns continue to increase. So we can see this in the column where we've captured the 3 years impact. However, an adequate policy response will lead to more frequent climate events, which will force governments to act. And this will start to create some market volatility. At this point, some assets may suffer from transition risk and become what we refer to as stranded assets. And this will significantly drag down equity returns. So again, we can observe this in the column, the 10-year column, where we've shown a double downwards arrow for global equity returns. If we then look over the longer term, the markets might start to recover as the effects from the policies that have been implemented starts to materialize. But as we can see, they never quite reached the same level as before. So again, using global equity returns as an example, and if we look in the 20-year column, this is shown as a single downwards arrow at this stage. So we've picked out a number of market drivers to discuss here, but a similar approach could also be adopted to the other market or economic factors, and indeed the other scenarios as well. So moving on to the next slide. So what do we do next? Using the information that we've gathered, we've then applied the logic to our economic scenario generator. So the gray lines on this chart represents all the scenarios from our economic scenario generator, and the median outcome is represented by the higher of the two dotted lines. We can then pick out the scenarios that corresponds to the narratives or the high-level impacts in the previous slide that we've assessed, and these are highlighted by the yellow lines on the chart. This will then allow us to determine a new median, which we have shown as the lower of the two dotted lines here, and assess the outcomes at different time points that are of interest. As we can see, the new median under this scenario is lower than the initial position. So if we click onto the next slide, Having done this analysis, we are able to come up with a distribution of outcomes for each of the 3 scenarios. Now, as noted previously, although it may seem like from a pure longevity perspective, the challenging times and head in the sand scenario may result in favorable outcomes for an annuity portfolio, the asset side implications could be much severe. So it's important to build up a holistic view of the implications of these scenarios on the balance sheet for firms. Indeed, the next step would be to start expanding this to also cover other potential areas that insurers may be affected by climate change, such as changing business mix, operational risk, and so forth. So that's the end of this section, and I hope this has provided you with an overview of the approach we've taken on scenario analysis. I'll now hand over to Ross to wrap up the session.
Okay, thank you very much, Clarence. So just to sort of bring this to a close, I think the question that we often get asked by firms in this area is, where do I start? Responsible investment or ESG, it's a very big topic. So that can feel a little bit overwhelming, and what we don't want that to lead is to inaction. So we think it's really important that firms formulate a plan of action. So break this down into a more manageable number of chunks, and then we can sort of tackle the problem sort of one step at a time. So we can click forward. So here on the slide, we've got one example of what sort of a high-level plan might look like, and this should all look pretty familiar to you based on what Clarence and Liam have just been talking through. So very quickly, what we're saying here is that we need to identify those drivers of the ESG risks. So that's the taxonomy that I ran through earlier on. And then we look to map those onto our balance sheet. Once we've done that, we need to come up with some metrics to allow us to quantify our exposures. And of course, we can use those metrics then to track our exposures and how they change over time. And alongside this, of course, picking up on from what Clarence has just run through, we need to develop scenarios to capture the range of potential future outcomes. And then once we've done all of that, we can start thinking about the sorts of actions that we want to take and indeed that we need to take. Just to bring this to life, because obviously it's pretty high level illustration, maybe pick one sort of example and show you how that might quickly run through this plan. So the example we thought we'd share is equity release mortgage loans. So some of you may be familiar with these, but in the UK, we've seen lots of firms, UK annuity firms in particular, investing in this asset class. And what these are, they are loans that are advanced to customers, and the loans are then secured against the value of those customers' homes. So ultimately, these are loans secured against residential property. So therefore, an important ESG factor for these assets is climate change, and in particular, flood risk. So we obviously, flood risk is something that was touched on earlier on, and just thinking about the past 6 months, for example, we've seen some pretty extreme winter flooding in the UK, and anyone who's seen the news, the sort of the pictures that we see there, we can get a feel for the severe damage that flooding can cause to properties. So going back to this asset class, and it's linked to residential property. Now, by way of metric, location will be an important one for us to consider. So which locations are much more exposed to flooding than others, and to what extent is our property portfolio concentrated in those sorts of regions? Then to the difficult bit on how we model this. So if we can click to the next slide. So here's a nice example that we've borrowed from a speech that the UK regulator gave last year. And in that speech, they referred to some analysis that had been performed by a group called ClimateWise using catastrophe models. And that analysis estimated that there would be a 25% increase in the number of UK properties at significant risk of flooding by 2100, assuming that global temperatures were to warm by 2 degrees centigrade. And that figure jumped up to 40% if we were considering a 4 degrees warming. And that analysis also showed how that risk was unevenly distributed across the UK. So if you look at this chart, the slide that we have up here, so on the left-hand side, that's sort of present day. The middle picture is the 2 degrees warming scenario, and then on the far right, we have the 4 degrees warming scenario. And on the maps, the darker the blue, the bigger the projected loss from flood risk. So you can see as we move to the right, we get more of those dark blue areas, so more projected risk of flooding. And we can also hone in on those regions that have the greatest risk. And you can, again, see how that's unevenly distributed across the UK. Okay, so if we click back then, so following all of that, then to wrap up, now we're thinking about the actions that we might want to take. And so for the firm in question, there's a few things it could consider. We could put risk limits on the asset class to make sure that we've got enough diversification by region. We might want to limit exposure to regions where there's a high amount of flood risk, or maybe if not do that, maybe make sure we have flood insurance protection in place there. Or we could also look to put limits on loan to value ratio, so limit the amount of loans that we would advance to customers in those areas where there's greater risk of flooding. So that's the sorts of things that the firm could consider, and hopefully that sort of quick example gives you a feel of how you might run something, a tangible problem, through this sort of plan. So conscious of time, so we're going to largely wrap it up there. So really all I wanted to say in conclusion is that yes, this is obviously a large and complex topic, but hopefully what we've demonstrated through the course of this presentation is that it's a fundamentally important one, and incorporating ESG into our businesses will be critical for us all in preserving financial value, so the stability of our balance sheets, but also in terms of retaining and attracting customers. So what we see with the firms that we speak to is that most are still at a relatively early stage in their ESG journeys. But my personal view is that the current COVID pandemic is only going to serve to push ESG even further up the agenda. So that's all from us for the time being. So hope you found that interesting and useful, and I'll hand back to Mike now to see if we've got any questions.
Hello all, and thank you Ross, thank you Liam, thank you Clarence, nice job. So let's have some fun. There's 3 ways we can do this. We have 2 questions in under the Q&A, so if anybody wants to type in a question, please use your Q&A option. Secondly, we can see all participants as little icons, and if you raise your hand, your icon will have a little hand on it. So if you want to ask a verbal question, please raise your hand, so please do that straight away. There is no hands in the air yet. And just to warn you, the third option is we all have microphones, so my 3 speakers can ask the audience questions and we'll have to answer those questions. So that's also an option we have. Okay, so let's go to the written submissions. First of all, the trick is to given breaches of ESG issues can result in large fines to companies, do you think there'll be a more liquid market for hedging ESG factors in the future? Any of our panelists want to take that one?
So if you could just repeat that one, Mike, just for me one more time.
If you click on the Q&A yourself, given breaches of ESG issues can result in large fines to companies, so breaches of ESG issues, do you think there'll be a more liquid market for hedging ESG factors in the future based on indices or other instruments? So I guess insurance through the markets, though, not through the insurance market.
I'm happy to kick off, and then maybe Liam and Clarence can add to it. I think that's a good point to have picked up on. I think the PG&E example that we saw earlier is a great example of that. That those fines, nothing draws the attention more than hitting someone in the wallet. I think in terms of the liquidity around hedging instruments, that may be, that to me feels like something that's maybe a bit further out. That seems quite an advanced development. I think potentially what that will shine more of a spotlight on in the short to medium term is, in that example, for example, firms getting their governance in order and having more of appreciation of the detrimental impact it can have on the investor community and the perceptions around their business. So I think it might actually, in the short term, sort of focus minds much more around governance factors and people trying to analyze these factors more intently than they have in the past. We may then find that the actions I alluded to at the end, for example, around hedging, that comes later down the track. I don't think firms are quite there yet. And once firms start looking at more of those options, then that might sort of stimulate the development in those hedging markets.
Okay. Can I maybe, unless Clarence or Liam have a burning issue to say on that, I think I'll jump on to more questions rather than in depth of one.
No, yeah. So the only other thing I was going to add on that is, yeah, we definitely see a direction in terms of more ESG type indices being done. So I would sort of expect sort of hedging instruments to follow suit. One of the main challenge that people normally have in terms of ESG indices in general, or ESG funds, is ESG is such a broad topic and people could interpret it differently. So I think it's just getting to grips when an index says that it's got an ESG screening process, fully understanding that, and before you even think about, you know, whether I'll be comfortable to put a hedge on those.
And it's just a point about agreement of what good and bad ESG risks are. I think at the minute, you know, at the extremes, everyone kind of agrees that there's certain companies are very bad ESG risks. Everyone can agree certain companies are very good ESG risks, but there's a huge chunk in the middle where it's quite a gray area. And, you know, even across different sophisticated ESG rating companies, there's quite a bit of disagreement. And that to me seems like something that would have to be ironed out a bit before we could get to a point where people are willing to trade in hedgeable, or trade in instruments that can hedge these risks.
Okay. To bring a question back to kind of the life insurance business model, if you remember, or if we think about life insurance companies actually having a huge store of assets, be they internal unit-linked funds or with profit funds. So the question is, to what extent do you think that as distributors of insurance-based investment products, insurers can turn their commitment to ESG investment to a competitive advantage? So sorry, maybe, is anybody doing that yet? And if not, please give free advice to our audience on what they should do.
Caveat that we are not providing investment advice through this webinar, but I'll let Liam and Clarence add their comments. But I think most definitely. I think if you look at you know, the asset management community and the sort of fund ranges offered by insurance companies, that to me has actually been one of the areas that they've been able to sort of move most swiftly on. So most asset managers or insurance companies offering some form of fund range which has some form of ESG sort of flavour or tilt to it. So again, reflecting the fact that there is already a strong, quite a rapid demand in a short space of time for these sorts of products. So you need to sort of act swiftly, have that in your toolkit to ensure that you're putting out the right message and you can track new inflows. And we see that as well with pension schemes as well, who obviously invest all of their money through external managers. You know, they have a strong sort of and the regulatory environment around them sort of requires them to think about this. So they need their managers to be able to accommodate that through their fund ranges. So I think for those, I think it comes back to my closing comment. For those that aren't sort of thinking in this way and trying to design products and fund ranges for customers that allow them to reflect their environmental beliefs and concerns, then I think they will suffer a competitive disadvantage over the longer term.
And, you know, I guess one key development to add here is that many of you may have seen that the European Commission published their final recommendations in March of this year about a common EU taxonomy of so-called sustainable activities. And so the EU has 6 environmental goals, and basically they're bringing in they brought in regulation now, and they're kind of it's being phased in over the next kind of 18 to 24 months, where all providers of insurance-based investment products are going to have to include, as part of their product documentation on their website and kind of in regular updates, as to whether or not the investments underlying those products have been assessed against this common EU taxonomy. So, you know, at the minute, there's some distinguishing themselves by saying, well, yeah, we're great, we're doing this stuff and assessing these ESG risks, and others aren't, but, you know, maybe it's not getting noticed. In future, if you're not doing it, you're going to have to put a disclaimer in there saying these investments have not been assessed. And, you know, my guess is that that's going to drive more questions from policyholders and saying, well, yeah, why aren't you investing, or why aren't you assessing against this taxonomy? So, you know, hopefully a kind of a positive shift forwards for the industry.
And just a very quick one, is ESG just a new badging of what we used to call ethical investing that we've been doing for previously, trying to just find funds that would sell?
So I think we would make a distinction between ESG investing and ethical investing. You know, ethical investing really is about values. So it's about the values you hold as an individual investor. So, you know, classic example is, you know, cancer charity. decides we don't want to hold tobacco stocks because, you know, just as an investor, that does not sit well. We don't care what the performance is. We're happy to sacrifice performance because we just can't be seen and we don't want to invest in tobacco stocks. ESG investing is more about the value rather than values. And it's about identifying the risk factors that a particular investment is exposed to and how that might threaten the long-term financial stability of that investment. So, you know, you might decide that, you know, tobacco stocks historically have been outperforming the market consistently for a number of years there. And you might decide, well, actually for us, that's a good investment because, you know, it's about, you know, we think we can get it at a good price and get some good value out of that. So slight distinction to be made there between, yeah, kind of screening and excluding things based on your values, I think.
Thank you. We're letting down the technology by not using our hand raising. So come on, some curious person use a hand raise. But while we're waiting, we have another written submission. Great presentation. Just to let those nice people who ask me the Q&A why I'm not reading out your name under GDPR, I'm told by the society I can't, but I'll text you later and say thanks. Great presentation. COVID-19 is priming us for a world where we need to get used to much lower but much more resilient returns in the future, question mark. And I like that question because what I was going to frame it is to say that if ESG frameworks work, I shouldn't be able to make supernormal profits anymore. Is that another way to ask that question? So is this world just trying to actually reduce variability, which is in a way to say improve resilience? That's yes. Okay.
It's a good question.
Yeah, don't think. Ask your questions. I'm conscious of time. We're nearly up, and we still have almost all our participants online. Ross, do you want to ask the audience a question and see if somebody will come back to you?
I think what would be great to throw out. We will reflect on that question and come back to you with some thoughts on that. It's a bit of a biggie. I guess what it'd be good to maybe, given the time, is to see if anyone in the audience would like to share their thoughts on how their businesses are sort of thinking about this, the extent to which they're embracing it and actually integrating it, and also some of the main challenges that firms are finding. You know, be it around data, just understanding the topic, getting senior management buy-in, the modelling, those sorts of things. So if anyone would be keen to share their thoughts on that, that would be really interesting.
Okay, open to the floor. If you just raise your hand, we can unmute you. You don't have to use your camera, don't worry. We won't judge your background. Brian, are you online? Is there anybody coming in?
Nobody yet.
Okay,
Just
that's
waiting.
not a problem.
Yeah.
You can be the famous person. We might break GDPR and call out your name.
Well, people can volunteer their names if they want, but in the first instance, we won't read them out.
Okay, from an audience point of view, I think they are respectful and polite rather than muted. So with your permission, Ross, I think we should tie up. We said 60 minutes CPD, we're just at 63. So any closing statements from our speakers?
Well, I think from my perspective, just to thank the Society for inviting us to speak today. I hope you found that interesting. And if anyone, you know, if there's any specific aspects of what we covered today that you wanted to delve into more detail, would be very happy to chat with you. You probably find all of our contact details through the Society's website or the Hymans Robertson website. Yeah, and enjoy your weekend and stay safe, everyone.
Okay. And on behalf of the Society, thank you all three speakers, Clarence, Liam and Ross. Thank you all attendees for coming along. If you want to re-listen to this or share it with your friends, it will be on the ActiveView platform for CPD purposes later. And indeed for people who are listening on the playback, you're very welcome. And that is where I will close and thank everybody for today. Brian, okay to sign off? If you say okay, I'll say thank you and good night.
Yes, indeed. Thanks, everybody.
Thank you all. Have a good weekend.
Thanks all.
All right,
Bye-bye.
cheers. Bye.